Investment masters like Warren Buffett recommended to buy and hold index fund as probably the best investment strategy for most people. However, numerous investors don't take this advice seriously. Why? Why people would rather pick individual stocks by themselves instead of listening to a living legend's suggestion? Well, maybe index funds are just not good enough to them. Then we will have this question: what is a good investment? If we check the most valuable companies in the US stock market, we see those big names that fundamentally change and support our daily lives. Apple, Google, Amazon, Walmart, Tesla, JP Morgan Chase, Coca-Cola, etc. These are undoubtedly excellent companies, each with market value of at least several $100 billion. And they've been investors' #1 choice for years. What about index fund? First, let me explain the term AUM, short for Assets Under Management, which is the total market value of the investments that a person or entity handles on behalf of investors. To figure out the AUM of an ETF, you're just gonna multiply the number of shares by the price per share, which is very similar to how a company's market cap is determined. Although ETFs are not exactly the same as public companies, they can be thought of as similar in terms of the way their value is calculated. We can use AUM of ETF to estimate its market cap, kind of like treating it as a public company. Now, if we add some of the largest index fund ETFs to this list, we end up with 4 ETFs ranking among the top 25. SPY with an AUM of over $369 billion as of today, IVV with over $303 billion in AUM, and VOO with over $285 billion in AUM. All 3 ETFs track the S&P 500 index. And lastly, VTI with over $278 billion in AUM provides exposures to the entire US stock market. As I just mentioned, those 4 index fund ETFs are currently worth more than 99% of the stocks in the market in terms of market cap, beating up heavy hitters like Coca-Cola, Costco, ExxonMobil, Bank of America, Pfizer, Nike, and a ton of others. This means buying those index fund ETFs is like placing your money on some of the most renowned firms in the market. From this perspective, have we been underestimating the value of index funds for too long? While some may argue that even though index funds have impressive value, they may not offer as much profit potential as individual stocks. While it sounds reasonable, especially considering that performance is a crucial factor in determining investment success. We invest in hopes of making more money, and one could argue that investing in top firms and holding them long enough could provide substantial profits than index funds. For example, Tesla, which is one of the top 25 firms on the list, has returned over 700% in the past 5 years. Or Apple, the most valuable company in the US stock market, which has risen over 250% over the last 5 years. This strategy looks really promising, right? Truth is, things don't always work like that. The past 15 years have been an unusually bullish time, and it is not typical enough to represent the overall performance pattern of the market. To have an impartial discussion, we must look at a more extended time frame, such as 30-40 years or even longer, covering a significant portion of the person's investment career. This is where things get interesting. A study by Hendrik Bessembinder, a finance professor at Arizona State University, found that from 1926 to 2016, only 4% of listed stocks accounted for all of the net wealth creation in the US stock market. The other 96% of stocks collectively matched the return of 1 month's treasury bills. In other words, most individual stocks underperformed the market benchmark, the S&P 500, and a small number of super stocks were responsible for the market's overall gains. It is also worth noting that no companies can always be on top. History has shown us that even the biggest and the most successful firms can fall from grace. Nokia, the former king of mobile phones, dominant in the 1990s and the early 2000s. By 2000, Nokia was worth over $200 billion and accounted for more than 4% of Finland's GDP. However, the advent of the smartphone era proved to be Nokia's downfall. The company failed to adapt to the new technology and was outpaced by competitors like Apple or Samsung. By 2012, Nokia's market cap has fallen to just $9 billion, and the company was forced to sell its mobile phone business to Microsoft. This is such a sad story I don't really want to bring up because I used to be a big fan of Nokia. Anyway, point being, despite our best effort to be disciplined investors by picking and holding the top performing companies, it may not always pay off in the long run. This is particularly true when considering a time horizon of 40, 50 years or even longer. On the other hand, the performance of index funds is more consistent. It is designed to replicate the performance of the index as closely as possible, meaning if the index performs well, so will the index fund. Again, using the S&P 500 as example, it's had positive returns in approximately 75% of all calendar years since its inception back in 1926. Now, let's talk about diversification. Everybody knows don't put all your eggs in one basket. But it is not always easy to put into practice when faced with the allure of high-growth stocks. This is probably another major reason why so many investors choose to completely ignore index funds as an investment option. Ray Dalio, the founder of the world's biggest hedge fund firm, Bridgewater Associates, which manages $124 billion for its clients, emphasizes diversification as his #1 rule for investing. But why is diversification so important? Because investing in stocks is essentially a game of who can survive through uncertainty and volatility. In a bull market, almost everyone can be profitable. It is the bear market that really differentiates smart investors who can endure economic downturns from those who lost their life savings. Maybe you'll be able to find the next super stock after recession, but what can you do if there's no money for you to invest at the time? So remember, staying in the game is as equally important as winning the game itself. And diversification is all about mitigating the risk of getting knocked out. A study by BlackRock found that a portfolio consisting of just 30 US stocks had a volatility of 90.1%, while a portfolio consisting of the 500 stocks in the S&P 500 had a volatility of just 12.1%. It's a great demonstration of two key points. First, investing in index funds is an effective way to diversify your portfolio and make it more resilient to market fluctuations. Second, if you think a portfolio of just 10 or 20 stocks is good enough to keep your money safe, it might be the time to take a closer look and see if you need to diversify further. Or if you are a person like me who wants to sleep well without worrying about the ups and downs of the market, index fund or index fund ETFs will be a no-brainer. Speaking of good sleep, it is tough not to stress out when you put in all that hard work researching and analyzing stocks only to see your portfolio tank. Even the most experienced investors can lose sleep over it. No investment is completely immune to market fluctuations, including index funds. But this doesn't mean index funds are inferior in any way. There's a high chance you will lose less than those who invest in individual stocks due to the well-diversified nature of index funds. More importantly, it can free up your time and mental energy. When purchasing index fund, you are essentially outsourcing the research and analysis to the fund managers, who design the funds to track specific market indexes. Basically, each index fund has established a set of rules to buy and sell, so you don't have to worry about which stocks to buy, when to buy them, when to sell, or how much money will be dedicated to each stock. It's all laid out for you in a neat framework. Sure, it might sound a bit boring, there's not much you need to do, but it also means you will have more time focusing on other important aspects of your life. Now you can catch up with your coworker over coffee, take your kids to a baseball game, or simply kick back and relax with your loved ones knowing that your investments are being taken care of. So if you value a good night's sleep and want to enjoy your life outside of investing, index funds are the way to go. Now we went through all the good things about index funds. What are you waiting for?